Let's dive right into this explainer. I am absolutely thrilled to have you here today because we're looking at one of the most fascinating financial evolutions of our lifetime. We're going to take a deep dive into how the crypto ecosystem is maturing over the next decade, from 2026 all the way out to 2036. The goal here? Cut through the noise and the crazy headlines and see what the actual data and expert forecasts are telling us about the future of digital assets.
Okay, let's look at our roadmap. We've got 5 key areas to hit today. First, the shift from speculation to institutional integration. Second, we'll cover systemic and operational risks. Third, future technological opportunities. Fourth, a 10-year perspective leading up to 2036. And finally, we'll wrap up with investor strategy and a quick summary.
All right, Section 1, from speculation to institutional integration.
So, by 2026, experts are pretty much calling it. The digital Wild West is effectively over. The fundamental narrative has completely flipped. You know, old crypto was all about the hype, the meme coins, just pure isolated speculation. But this emerging new crypto, it's a totally different beast. We're looking at something that's becoming a fully integrated piece of the traditional financial system, or TradFi, shifting its focus to real, revenue-generating utility and actual technological infrastructure.
A massive part of this shift really centers around Bitcoin solidifying its status as digital gold. And it's kind of ironic, right? The very institutions that once totally dismissed it are now projecting equilibrium targets sitting broadly between $120,000 and $250,000. They're increasingly viewing it as a long-term store of value and an inflation hedge. But quick reality check. High volatility is definitely still a central factor here.
So what's actually driving all this? Honestly, it comes down to structural capital. Banks, ETFs, major investment firms, they're all adding digital assets to their standard portfolios right now. And at the same time, we're finally seeing clear global legal frameworks emerging around how assets are custodied and how stablecoins operate. This kind of regulatory clarity brings massive, structured capital into the space, and that fundamentally changes the rules of the game for everyone involved.
Which brings us to Section 2, Systemic and Operational Risks.
Now, institutionalization isn't all sunshine and rainbows. It brings a whole new set of complex, systemic dangers we really need to unpack. Crypto isn't operating in some isolated little bubble anymore. Today, it's highly correlated to traditional finance. What does that mean for us? Well, if central banks tighten monetary policy and trigger a liquidity crunch, risk on assets like crypto are going to get hit first, and they'll get hit the hardest. Add to that the constant threat of regulatory shocks, like an asset suddenly being classified as a security, or aggressive leverage triggering cascading liquidations, you can start to see how macro shocks have a hugely magnified impact in this space.
Now, what's really interesting here is how you can practically manage these threats. You obviously can't control global macro events, but you can proactively map out preventative measures. For example, you can mitigate cybersecurity risks by simply using cold hardware wallets. Or you can navigate regulatory crackdowns by strictly using compliant legal exchanges. And if you're worried about a project going bankrupt, the best defense is doing deep fundamental analysis on their white papers and looking for actual verifiable revenue.
But there's a really fascinating paradox here. TradFi integration. Think giant funds from the likes of BlackRock or Fidelity holding massive amounts of Bitcoin in ETFs actually contradicts crypto's original spirit of decentralization. I mean, it literally creates single points of failure. Furthermore, if a major stablecoin were to suddenly lose its peg to the US dollar, that could trigger a massive interconnected liquidity crisis across this entire newly centralized ecosystem.
Let's move on to Section 3, Future Technological Opportunities.
Right now, arguably the single biggest opportunity area is RWA, or real-world assets. Basically, this is the process of taking traditional financial assets, stuff like real estate, private credit, government bonds, and tokenizing them directly onto the blockchain. This is absolutely huge because it transitions crypto from just being a speculative investment vehicle into the actual functional plumbing of global finance. When we neutrally map out the risk-reward ratios of these emerging sectors, a pretty clear picture emerges. RWA offers medium to high return potential with relatively lower risk, mainly because of that heavy institutional backing. On the flip side, things like AI and Web3 integration offer very high return potential, but, and this is a big but, they carry extremely high risk. It's a really clear snapshot of exactly where the capital and development energy are flowing right now.
And beyond just tokenizing assets, we are seeing some incredible tech synergies. Layer 2 networks are finally cracking the code on speed and cost issues, meaning the old idea of buying a cup of coffee with crypto is actually becoming feasible. But even wilder than that is the synergy between AI and blockchain. Imagine a fully automated machine-to-machine economy. We're talking about AI agents securely transacting, negotiating, and settling with one another instantly, all using crypto as the native currency. That isn't sci-fi, that is actively being built today.
And this brilliantly illustrates another major leap: liquid staking. Basically, this is a mechanism where you lock up your assets to help secure a network and earn a yield. But, crucially, you receive a derivative token in return, so you don't actually lose your liquidity. It perfectly replicates traditional dividend and passive income logic, which makes it incredibly attractive for massive professional funds and everyday retail investors alike.
All right, Section 4, 2036, a decade perspective.
So, if we zoom out and look at expert analysis of current tech and economic trends, we get this 10-year probability forecast. Now remember, these are analytical probabilities, absolutely not guarantees. But analysts are assigning a 50% probability to steady growth and deep financial integration. There's a 30% chance we see massive, explosive growth, and a 20% risk that the whole market just underperforms expectations. Overall, the scale is heavily weighted towards steady institutional integration over the next 10 years.
Breaking down the specific outlook for the major networks. And again, I'm impartially summarizing expert forecasts here, not giving financial advice. Bitcoin is generally viewed as having low to medium risk, solidifying its role as a global reserve. Ethereum sits at a medium risk, acting as the core infrastructure for smart contracts. Solana offers incredibly fast execution, but carries medium to high risk. And XRP remains highly focused on cross-border payments with a medium risk profile, obviously pending broader adoption.
When we really think about the reality of 2036, it strongly mirrors the early days of the internet. Yes, Bitcoin will likely solidify as digital gold. Yes, smart contracts will almost certainly dominate sectors like digital identity and real estate, and it's highly likely central banks will issue their own digital currencies. But here's the crucial part. Just like the dot-com bubble, thousands of useless altcoins that lack any real utility are inevitably going to face a massive purge and just die off.
Because of that inevitable purge, the single biggest risk for a long-term investor over a 10-year horizon is simply picking the wrong project, period. The second biggest risk? Panic selling during the market's notorious short-term volatility. Seriously, survival in this space requires immense psychological resilience against all the daily market noise.
Let's wrap things up with Section 5, Investor Strategy and Summary.
Let's move to and see how this builds into an actionable, grounded framework. How do we actually synthesize all these forecasts, risks, and tech opportunities? Well, experts recommend 3 vital non-financial advice steps. First, track traditional finance correlations so you can spot systemic liquidity crises early. Second, build a strategic basket. Keep 70 to 80% of your portfolio in blue chips like Bitcoin, Ethereum, and Solana to minimize the risk of a project literally going to zero. And third, practice emotional hedging. Simply put, avoid buying when the market is in a state of extreme greed.
And why is that emotional hedging so absolutely mandatory? Because of one massive glaring number: 70 to 90%. Historically, even the absolute top tier, highest quality projects in this space have faced brutal drawdowns of 70 to 90% during bear markets. If you can't stomach that kind of volatility, you just won't survive the 10-year horizon.
To sum up the best practices for the decade ahead, follow cyclical halving analysis. Seek out protocols that generate actual real revenue and share it with their users, that dividend logic we talked about earlier. And most importantly, ignore the social media hype groups. Doing deep analysis, like reading annual reports and tracking actual developer activity on GitHub, is literally the only way to separate the signal from the noise. You absolutely have to focus on technological utility.